Hi all, it's Joe Duffy again, and this video is our last and third on the option strategies that we use. And we're going to talk a little bit about a strategy here called the diagonal spread, which is a variation of the debit spread. The purpose of this strategy is we have multiple chances to use or to get time decay working for us. And we'll show you how that works. Okay, we're going to use puts here to give you a different perspective. So in this case, our hypothetical view is the market's going down. Okay, keep in mind all these are for examples only, and they're not actually the numbers we might use or our actual views at the time. Okay, so what we're going to do is we've got the November strike, November 1st strike up here, closed 296.28. We're going to scroll down to we're going to buy a 297 put for 416. So let's remember that the 297 is 416 because I have to switch over to a different expiry now. Now, this October 16th is actually 3 trading days, Monday, Tuesday, Wednesday. They expire. Okay, so I've got a November 1st long put, and I'm going to sell an October 16th short put. Remember, there are 3 expiries a week in the S&P. Okay, so we can sell this like 8 times between now and expiry of the November 1st option if we wanted to. So we're long a 297 put. Let's now sell an out of the money put, which is 295. Remember, the 296.28 is the strike. So we're going to sell that for $1.42. So our initial 416 investment is now down to 274, which is obviously substantially less. So now we've only got 274 invested. If we're right and the market drops down to 295, okay, right here, then this 295 is worth 0 still. And now our 297 has an intrinsic value of $2 plus a lot of time value, so it's probably going to still be worth $5, $6 somewhere in there, whatever it's worth. Now we only paid 274, remember, because we've mitigated our cost with this here. So the market does not have to move down very much. And if we were bearish here, this would actually be quite a good strategy. The numbers work quite well because a $2 move would almost double your investment. Now, so if this expires, worthless, say, the stock ends at 295 or above, then we have a chance to go to the next expiry on October 18th and sell another put. Okay, so we have 8 chances to do that. So what does that do? What's our advantage? Well, obviously the short-dated options have the fastest time decay. And some of these short-dated options have a lot of time premium. Again here, this is a good example. This only has 3 days to trade, but it's worth $1.42. It's a 295 put. Doing the math, the stock's going to have to get to say 293.5 or so just to break even. Okay, that's a fairly hefty time premium. That's an almost 3-point drop in 3 days, which is easily possible. It's still a hefty time premium. So instead of having to pay that away, now we're making it. Okay, and if we do make it, we get to turn around and have another chance to do it again. And if we're long the November 1st, we've got 8 chances. If we're long the December 1st, then we've got like 17 chances to sell this short dated against a long dated. Now, sounds too good to be true. It's not always. If the market goes against you, if the market goes against you, your losses are mitigated by the spread because the short is going to go down as well as your long. So you're not going to lose as much money as quickly for sure, but you still eventually have to be right on the direction of the market. Advantage is when you are wrong, and sometimes you will be, your loss is mitigated. And if you are right, and if you're right big time, then if let's say the market goes down to 290, all right. So our 297 is now worth $7 intrinsically, and it's got a time value of a couple bucks still, or $1.50. It's $8.50, $9. Okay. Now, the 295 that we sold is now worth $5. The difference between 295 and $2.90 where the market is now. So we have to buy that back for $5, but our other one's worth $9. So we've got a $4 difference, and we only paid $2.74, so we're still well ahead. But that's if the market goes, hugely your way. If the market just goes a little bit your way, that long dated is probably going to hold more premium, so the spread would be more than $4. Now, if the market goes against you, obviously, like I said, you're going to have another chance to sell another option against this. Okay, so has a lot of the advantages of both the credit spread and the debit spread. You get time decay working for you. You do mitigate some of your loss when the market goes against you. You know what your maximum loss is, and your profit can be a little bit more open-ended because you have multiple chances to sell against your longer-term position. Okay. Now, if you've never traded options before, this one is going to be a bit more confusing than even the credit spread. Again, once you've become accustomed to this, once you see a few examples in real time, the light is going to go on. It's much like I know for myself, at least when I started learning about options many, many years ago, you kind of had to write it out and see where these things are going to go. And similar to this strategy here, once you write it out and see where your risk is and see what the parameters are, this is going to become second nature, and you'll be able to find these along with me. Okay, now lastly, I'll point out that each of the three strategies we talked about has a time and a place. Okay? And it's important to know when that time and place is, because if you're applying the wrong strategy at the wrong time in the wrong market environment, you're not going to make as much money as you could, even if you're right. Okay, so that's what we talked about. Some of the premiums change. Premiums, when I say premiums, that's the cost of the option, how much time value it has, how much the out of the monies are worth compared to the in the monies. All those things vary, and if you're not really intimately familiar with watching options, they can vary far more than you could ever imagine. So that's all part of the strategy, figuring out what is best when. Okay, so that's it. If you have any questions, it's joe@jdtradingsystems.com, joe@jdtradingsystems.com. Thanks for listening.